Welcome to this video on ISO versus NSO, where we'll explore the tax treatment of stock options. Stock options are a common form of compensation in startups and tech companies, but understanding the difference between incentive stock options and non-qualified stock options is crucial for both employees and employers. Let's dive into these two types and see how they differ in terms of taxation and eligibility. Before we compare ISO and NSO, let's understand what stock options actually are. A stock option is a right given to employees to purchase company stock at a predetermined price, known as the strike price or exercise price. It's important to note that stock options are not actual shares of the company. You must exercise them, meaning you must pay the strike price to convert them into actual shares and become a shareholder. This distinction is key to understanding how they work. Incentive stock options, also known as statutory stock options, come with specific requirements and benefits. First, only current employees can receive ISOs, which means contractors and advisors are not eligible. ISOs offer favorable tax treatment when held properly, which can result in significant tax savings. However, there's an annual limit. Only $100,000 worth of ISOs can vest per year. Additionally, ISOs have a maximum term of 10 years from the grant date. Non-qualified stock options, also called non-statutory stock options, are much more flexible than ISOs. Unlike ISOs, NSOs can be granted to anyone: employees, contractors, board members, and advisors. However, they're taxed as ordinary income at the time of exercise, which typically results in a higher tax burden. The upside is that there are no annual vesting limit restrictions like with ISOs, and companies have much more flexibility in setting the terms and conditions of NSOs. Let's compare the key differences between ISOs and NSOs side by side. For eligible recipients, ISOs are restricted to employees only, while NSOs can be granted to anyone. Regarding the annual vest limit, ISOs are capped at $100,000 per year, whereas NSOs have no limit. The most significant difference is taxation at exercise. With ISOs, there's no ordinary income tax due at exercise if held properly, but NSOs are subject to ordinary income tax on the spread between the strike price and fair market value at the time of exercise. Understanding the tax treatment of ISOs is critical. At grant, no tax event occurs. At exercise, there's no ordinary income tax, but the spread between the strike price and fair market value may trigger alternative minimum tax, or AMT. At sale, if the shares are held for at least 1 year after exercise and 2 years after grant, the gain qualifies for long-term capital gains treatment, which has a lower tax rate. However, if you sell early and don't meet these holding period requirements, it's called a disqualifying disposition, and the spread is taxed like an NSO as ordinary income. The alternative minimum tax, or AMT, is a critical consideration for ISO holders. AMT is a parallel tax system designed to ensure that high earners pay a minimum amount of tax. For ISOs, the spread at exercise, which is the difference between the fair market value and the strike price, is considered an AMT preference item. This creates a unique challenge. Even though you don't receive any cash when exercising your ISOs, you may still owe AMT on the paper gain. This is why it's essential to plan carefully before exercising ISOs. The tax treatment of NSOs is more straightforward than ISOs. At grant, no tax event occurs. At exercise, the spread is immediately taxed as ordinary income, and for employees, this is reported on your W-2 form. When you eventually sell the shares, any additional gain or loss from the exercise price is treated as capital gains or capital loss, which may be short-term or long-term depending on how long you held the shares. The key point is that NSOs have simpler tax treatment, but you face a higher tax rate at exercise compared to the potential benefits of ISOs. Let's look at a concrete example to compare the tax implications. Assume you have 1,000 shares with a strike price of $10 per share. You exercise when the fair market value is $50 per share and later sell at $100 per share. With ISOs, At exercise, you may owe alternative minimum tax on the $40,000 spread. At sale, if you meet the holding period requirements, you pay long-term capital gains tax on the entire $90,000 gain, resulting in lower total tax. With NSOs, at exercise, you owe ordinary income tax on the $40,000 spread, and at sale, you pay capital gains tax on the additional $50,000 gain. The NSO route typically results in higher overall tax, but the treatment is simpler and more predictable. Let's wrap up with the key takeaways. First, ISOs offer tax advantages through preferential capital gains treatment, but they come with strict requirements around holding periods and employment status, plus the risk of alternative minimum tax. Second, NSOs are much more flexible and can be granted to anyone, but they result in higher ordinary income tax at the time of exercise. Third, remember that ISOs are only available to employees, while NSOs can be granted to contractors, advisors, and board members. Finally, and most importantly, always consult a qualified tax professional before exercising your options, as the tax implications can be complex and vary based on your individual situation. Thank you for watching.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.